Okay, guys, welcome to the Wealth Creation Show today. This is all about, it's the most topical subject going. It's inflation versus interest rates. Is there a strong correlation between the both of them? I mean, how does interest rates affect inflation? How does inflation affect interest rates? Is there a strong relationship between the two of them, or is it just, did actual economists know what they're talking about? Genuinely, Richard, do they know what they're talking about? Because I was often told, welcome everybody on TikTok, by the way. I was often told by a very successful economist, it's like once economic policies are put in place in order to curb inflation or curb interest rates rising, you're too late. It's like a ship leaving the harbour. It gains so much momentum, like the economy. By the time you know what you have to do in order to slow that ship down because of the problems that are happening, you're too late. It's already going to happen because you know what I mean? Because for the next 2 or 3 months, it keeps going on regardless. And what you do there now will only impact on you. So if you increase interest rates, if you decrease interest rates, it's only going to affect you in 3 to 6 months' time. Does that make sense?
Yeah, and I think, well, I don't know about everybody, but obviously, and to me, I would always think that obviously that interest rates and inflation do have a kind of symbiotic relationship, but that might not always be the case.
Mm-hmm. Let's talk about the esters.
Yeah.
For anybody out there, I know it's not the Wealth Creation Show sort of thing, but let's talk about the esters. You know, we've come again and we've actually proved ourselves. In 2018, I'll tell you, Richard, in 2018, I'll put this all down. I went away with my tail between my legs at the Esters and the Oscars. And you know that, the States, the Oscars in London, because basically we got a bronze in 2018. That was third place in the whole of Scotland. Now, to me, it's like I'm either first or I'm nothing. But we did get the best in county for sales and lettings as well. But in 2019, I actually didn't enter the Esters for the very reason that I was just like scunnered. Well, it's like, how can I not be acknowledged for what I do? And you know, 2019 was a big learning curve for us, and we learned a lot. We focused on our customers. We did everything possible to do that, and then we came back with a vengeance. 2020, didn't we? It was like, I mean, it was the best in county twice for sales and lettings again. We got a gold and silver for the sales. That's number 1 in Scotland, number 2 in Scotland for the 2 offices for Leven and Cooper. And you know, so that was a really, really good achievement. And then 2021, we capitalised on that even more. We got a gold, a number 1 and a number 3 in Scotland, gold and bronze. And then we got a silver and a number 2 in Scotland for lettings. And then we got a county, sales and lettings, best in county. And then we also got best small group. How could you top that? Well, 2022, this weekend, number 1 again.
Yeah.
Gold in Scotland, which means, again, consistent, Richard, silver in Scotland. And then we got best in county again for sales, and then best in county again for lettings. And then we got number 1 in Scotland again for best local estate agent group from 2 to 5 groups. So what does this tell us? The great thing is it's all voted for by our customers, isn't it?
Yeah, that's the main thing for me and the rest of the lettings team, is that it's your landlords that do these votes that get us to this position.
Yeah.
Silver in Scotland to me is a brilliant achievement. Always room for improvement.
It does mean, I mean, how far do you need to improve? I mean, you were sitting at 97% approval rating.
It was the highest percentage we've ever had.
Yeah, how could you improve on that? But you can. There's a 3%. But then it's the differential. This comes down to, again, you know, wealth creation and all the rest of it. Do you continue to pursue perfection to the detriment of actually the marginal gains that you're actually going to achieve with the amount of input you're going to have to put in? And often we talk about this in the wealth creation shows about, you know, for God's sake, just do it. It's like done is better than perfect every single time.
That's something that I've had to adopt in what I do on a daily basis. Because to strive for perfection sometimes isn't always the answer.
No, it's definitely not. You know, there's a lot of people that have tried for perfection and they've never achieved anything because they don't start the journey and they're not prepared to accept any failures. They're not prepared to accept any failures on the way. So therefore, you show me a person that's never failed and I'll show you a person that's never succeeded in anything. Ultimately, they're probably a critic. And it's not the critics that count. It's the person in the arena with the blood, sweat and tears that make it happen day to day, every day, for the creation of their wealth, for their future, for their generations, their family generations as well, and the people that have all to come, and the people round about them, at their team they're involved with as well. Let's talk about inflation versus interest rates. Do you know much about this, Richard? Is this something that you've ever thought about, or is it, just out of curiosity?
In all honesty, not to any great depth, the relationship between inflation and interest rates. And inflation is a tricky one and something that not a lot of people understand. So I've read through what we're going to talk about today, so I think it's quite good to explain that and show you what's going on in the present circumstances of things at the moment.
Absolutely. It's like smoke and mirrors, isn't it? It's like, I always say, unless you know the bare basics of what inflation means and how it affects us, and also interest rates and how it affects us as well, we'll never be able to decipher what we're told on the television or what we're told from the media. And the most important thing is to educate yourself to get the right information. So when you're told something, based on what you know, and the fact that if this is actual reality, or if this is a fabricated. I think they say in court, I think you must be mistaken. Whereas I just say it's a damn right lie. The Bank of England has increased interest rates again for the 7th consecutive time since December 2021 to 2.25% base rates in September, in a bid to bring inflation back to 2%. Now, did you notice that wee smoke and mirrors thing on the media where they said that inflation is at 10%, and then they flashed up on the screen and it was 9.9? Well, that's no 10% as far as I'm concerned. That's near 10%, but that's no 10%. That's 9.9. So it can go down from there, and it's probably never reached 10% then, if that's the case. So they want to make things more affordable again, but the key here is, why is it so important to control inflation? This is what we're going to talk about. Is interest rates the only way, and does it really matter, and how does it actually affect us? So to take a look at how inflation affects interest rates, we're going to look at things like, the questions I'm going to ask today in this show is, why are prices rising so fast? How is the rate of inflation measured? How does higher inflation, this is a good one, does higher inflation mean higher interest rates? This is the correlation, the strong relationship between the both of them. Is there actually a strong relationship? We'll call it a correlation. That's what they call it in mathematical terms. How does raising interest rates help inflation? And what does higher inflation mean for your savings? And how will inflation affect your pensions? That's another key one as well. So these are all the key points we're actually going to talk about. And we're going to break this down for everyone. So let's go on. Let's kick off and let's see where we go from there. So the first one for me is, why are prices rising so fast? Well, the cost of living, as measured by inflation, is still very high despite the fall month on month, and the consumer price index, this is one measure, the CPI, hit 9.9% in August, a fall on July, which was 10.1. Do you notice how we never heard that in the media?
I was just going to say, we never got it.
Actually, inflation fell from July to 9.9. They all said it was 10%, and they were all going about it's the highest rate since so-and-so, coming out with a date at the highest rate since 3 days ago or something like that, but just to give a headline, there are complete bampots out there. It's like they're definitely trying to get into our heads and influence us in some sort of way to be scared and afraid, because that's how other people make their money.
Yeah, we've picked up on a few shows that we've done things, Jim, and looked at stats, and it seems that they take a really small snapshot of statistics from a short period of time and use that as the head to obviously generate these scaremongering headlines, rather than looking at it on larger timescale, where things then obviously sort themselves back out.
How many people out there believe the media from day to day? No, really.
No.
If you believe the media, put something in the comments and tell us you believe the media. If you don't believe the media, put something in the comments and tell us you don't believe them. Maybe put bullshit in the comments. I mean, the Bank of England has actually previously warned that inflation could reach as much as 13% in the winter when the energy price cap goes up again. But it's not going to, because we've actually capped it. So they actually think it's that cap that they've put in place has actually influenced it by 5 percentage points. So rather than have 18, this is why they're saying 13. The government has since introduced the energy price cap, freezing energy home bills for £2,500 for a 2-year period. Now, to be honest, this is an average £2,500. There's going to be some people that are way above that. There's going to be some people that are way below that. That's why it's an average of £2,500, because it's not, you're only paying £2,500 regardless of the amount of units that you're using. So you can pretend you're in the tropics for the next 2 years and you only pay £2,500 a year. It's not like that at all. It's just the average, remember. So if you use more, guess what? You're getting charged more. So the bank is now forecasting the CPI, the Consumer Price Index, to peak just under 11% in October. Now we're sitting at 9.9. I have a sneaking suspicion that's going to go down again. I don't think it's going to go up in October. What's your thoughts on this, Richard?
Well, I don't know. So what's going to push those prices then? If it's going to, what's going to push up prices to that level?
Okay, so what is?
Well, the main thing, obviously, at the moment is going to be energy bills. By far, one of the biggest contributors to that, and most people will be aware of that, obviously, at the moment. Gas prices have rocketed as economics around the world have reopened following like coronavirus and lockdowns and things, and that's what's obviously influenced that. And also the war in Ukraine, which we've touched on quite a lot, has really exacerbated that problem.
See, the war in Ukraine thing, I think it's like what we used to do in the board meeting. And see, this is I'll let everybody into a wee secret here. This is what happens in the PLC world when we go to public limited companies where they have to report to the city. So they have to report to the city every single time, usually every single quarter, every half yearly, depending on how big they are. And when they put a report into the city, sometimes if the accounts haven't gone as great as they thought and the results haven't gone as great as they thought, the first thing they do is they look for something to blame. Do you know how I know that? Because I was in that sort of way years ago when I was involved in, industry. That's the kind of thing. They look for something to blame. And I think the war in Ukraine is going to get used quite a lot to blame poor results from companies, when in actual fact, it possibly wasn't at all. I definitely think that's the case. So on average, April. So what happened in April? And in April, average gas price and electricity prices jumped by 53.5% and 95.5% respectively compared to a year ago. Now, prices were expected to jump 80% in October after Ofgem raised the price cap again.
Mm-hmm.
The government, who could afford that? The government's energy freeze. And listen, when you think about the logic of this, Richard, who the hell can afford that? If most people are living from hand to mouth and most people have too much month at the end of their money, in other words, their money runs out before they even get to the end of the month. You know that because you see in the pubs the week before payday, and the pubs are empty, and payday arrives and like they're mobbed.
Yeah.
So you kind of think to yourself, who on earth is going to be able to afford that? So this is why the government's obviously stepped in. The government's energy freeze until 2024 is still a 27% increase compared to what households are actually paying right now. But you'll still get an energy at £400 discount. And we know it's coming. It's £67 a month. I think
I think there's a lot of people already receiving that, I think, as far as I'm aware.
Yeah. So that's one of the things that will affect inflation. What's other things, Richard?
Yeah, well, as we spoke about in previous shows, like the cost of living crisis, food bills is a really big contributor to that. I mean, food items such as wheat and oil have also taken quite a big hit. Supply chain issues have been compounded by, again, they say obviously the war has had an effect on that, which I agree. Obviously, when it comes to food and supplies, that is probably the case, and it further impacts access to supplies and things. Now, analysts warn food prices could rise by 15% this year, and the latest Consumer Product Index figures show that food inflation could hit 12.7% by July.
Yeah, but when you think about the logic of this, right? Now, we had looked at this ages ago, so, you know, we're sitting at food inflation hitting that, but is that no just overall inflation anyway? Because we're talking about food prices 15% this year, and we've had that. And now this is, when we looked at this originally, it was 12.7 July, but we're now into where we are, and we're sitting at round about what? We're sitting at round about 9.9. So we're sitting at 9.9. So it never got to that, really. It actually began to come down. So according to the Office of National Statistics, housing and housing costs, clothing and footwear, as well as recreation, hotel and restaurant costs are also going up. For homeowners, while the Bank of England is attempting to raise rates by cooling inflation as well. More than 1 million homeowners are seeing their mortgage rise in response to this. So if that is the case, that's why prices are now rising so fast as a result of all this that's happening. So this is how inflation's measured. This is how they do it. So this is where they get this figure from. This is the next question we've got to ask ourselves. How is this inflation measured? So we'll understand the crux of it and what it is to everybody out there. Well, when the economists at the Office of National Statistics calculate the rate of inflation, they look at the price of a basket of products and have they risen or fallen compared to the previous years. Now, seeing that basket of products, now and again, some of these products actually come out and some of these come in because they become less popular. So they use it in a different way to calculate inflation. So sometimes inflation will change because of this basket of products. But it's not that significant because they use what they call seasonally adjusted statistics. In other words, that's to smooth out all the swings that happen in there. So they seasonally adjust it after that process. They do that with everything. They seasonally adjust. It's a statistician's thing. It's to smooth out stuff, as I said. And you can look up on Google. It's seasonally adjusted and why do they do it? In the year to the August 2022, the consumer price measured inflation rate of 9.9%. This was calculated by choosing now here it is here. You think it's just one or two items. It's 180,000 products and services based on what people typically buy. That's why when they lose one and they add one, it's not that significant in the whole scope of things, and it shouldn't influence things that much. The overall price of the basket of goods is plugged into the CPI, which is the Consumer Price Index, which is mostly widely used as the measure of inflation now. Now, the Retail Price Index used to be the previous measure of inflation. I don't think anybody actually realised that, but they changed to the CPI because it made it look better.
So do you think? But then I wouldn't think
that would be what you said. They changed they didn't like the Retail Price Index, so they actually changed to the Consumer Price Index to actually come up with a different measure because they didn't like that. It's like lies, damn lies, and statistics. But this is factual, remember. So what we're giving you is the information in order to how they measure it. Now, Richard, what were you going to say?
I was just going to say, how does that make it accurate then, or is it as accurate as the CPI, as the RPI?
Well, for some reason, they actually felt that it was going to be more accurate reflected. So it's another inflation, like the CPI, right? The Retail Price Index. It draws the basket of goods and services, but it adds mortgage payments.
Okay.
Now that mortgage interest payments used to be added into this before, and because mortgage interest payments was going not in favour of their measure, they decided to take it out and create the CPI. See, like the manipulation. And the
Yeah,
figure,
that is manipulating it.
it's
Yeah.
like we don't like that figure now. And what can we take out that's influencing that figure so much? It's like, oh, I tell you what, let's call it the CPI, and we'll no use the RPI anymore because it actually includes interest payments for mortgages. That's it, because they now, to be honest, is there, is that double counting then when you think about it? Because if you put the interest payments in, and how that's a done deal if interest rates are going to go up to curb inflation. See what I mean?
Mm-hmm.
If they put interest rates up to curb inflation, then they're causing inflation because they've got the interest payments included in it. And that's why they didn't want to start using the RPI anymore. They wanted to start using the CPI index, which excluded mortgage interest payments. So in the year to August 2022, the RPI, including the mortgage interest payments, was actually 12.9. as opposed to 9.9. See how that's influenced that by 3 points. So this is the chart that I was going to show you here. So this is it right here. Let me get this on so you can see it. Oh, that's the show. Try to get rid of that bit at the bottom. So here it is here. If you zoom in on that, you'll see all that, how they've got the food. See up there, food and non-alcoholic beverages, clothing and footwear, furniture, household goods, restaurants, hotels, alcohol, tobacco. So they've got all the different colours down in here and how that comes out, recreation and culture. And then they've got it all at the bottom. So see how that's gone, how you have that August 2020, November 2020, February 21, May 21. Apologies to the people on TikTok. You can't show graphs on TikTok if you're doing lives. It's no easy. But we are showing it on the screen. So if you go to YouTube, you will actually see it on our wealth creation show on our YouTube playlist, which is on 5 properties. Anyway, so you can see how that's gone up dramatically. Look at some of the biggest moves. Look at the dark green housing and household services. I think that is that. Yep. Housing and household services. Look at how that's gone up.
Yeah.
That's a huge cost there. And then the next one is transport. That transport stayed pretty stable. You give it its due.
Yeah.
The blue one, which is dark blue, is food and alcoholic beverages, or food and non-alcoholic. Sorry, think the alcohol. And then you can see alcohol's just kind of been the same.
Yeah.
I wonder if it keeps going as it's going, if that alcohol figure will get a bit more. Just purely the fact that that would then prove to be if people drink a lot more in recessions and in times of challenging times. That's all. That's curiosity more than anything. But you can see how that builds up to the profile of all that. But really, the housing and the household services costs are the biggest. So if you want to bring down inflation, the thing that you should concentrate on the most is housing and household services. That is water. That is gas and electric. That is, it's possibly as well, if that's the CPI. So that'll not include interest rate payments. That'll be including things like contractors working on your house, I would imagine. So, sort of things like that. It's everything to do with your house. That's where all the costs are coming from.
Like repairs and maintenance and upgrades or whatever. Yeah.
So that's us covered what inflation is actually and how it's actually measured. So what is the bank rate? What does that mean? Do you want to cover that, Richard?
Yeah, so the bank rate is obviously the interest rate that's set by the Bank of England. Now it currently stands at 2.25% after the bank increased from 1.75% in September. And this is September past, obviously. Now that's the 7th rise since December 2021, when the rate was 0.1%.
Yeah.
So the rate affects all sorts of aspects of the UK economy. Now that will include how expensive mortgages and loans are, and how much savers get paid for their bank deposits, which we're aware is not very much. And it's sometimes called the Bank of England base rate, and it's set to be central in the bank's 9-member monetary policies committee. So, do you want to elaborate on the monetary policy committee, Jack?
Well,
just briefly, because I'm a wee bit unsure about it myself, to be honest.
Right,
So I know there'll be other people out there.
Let's talk about the Monetary Policy Committee. 9 people are membership. So Mark Carney was once the head of the Monetary Policy Committee. So they all get together and they look at all the overall economy and they look at where inflation is and look where all the key indicators are. And then they decide whether they should be increasing, decreasing, or staying with the current base rate at the Bank of England. Now, the Bank of England is the one that lends the money to the other banks.
Yeah.
So they're all intertwined. So they have swap rates and all the rest of it. And then they then set their rates. That then sets the rates for the other banks. It also sets the rates for how much they'll lend money to the government as well. That's another key thing. So that's why base rates, when base rates go up as well, it also then sets things like bond rates. Therefore, people from overseas tend to invest more money in the UK because they're getting a higher return because the bank base rates have gone up. So that's why when you bring bank base rates up, that's why your economy, your pound against the dollar and the pound against the euro, against other countries get stronger because people overseas want to invest more money, more of their dollars, more of their euros into our economy. And that's why it gets stronger as a result against these currencies. There's a balancing act.
Yeah.
Has to happen. So that's primarily what the bank's base rate is. It's all based as well on what they can borrow money, as I said, from other people and swap rates. Very confusing all the way around. So the next Bank of England interest rate decision will be on the 3rd of November. Now, the 3rd of November, we've been told this morning already by the head of the Monetary Policy Committee that we're going to interest rates are more than likely to go up, but it's how much they're going to go up base rates by is probably the most important thing. Now, the committee voted by 0.5. Now, we talked about it before it was set on the 21st or the 22nd of September. We said, I did say actually 0.5. I didn't think 0.75 would happen because 0.5 is to see where we go. I do think possibly that we might have another 0.5% increase. I know it sounds daft, but I can't see anybody thinking, saying, maybe we should do 0.75 to round it up to a right even 3%. I can't see anybody taking that decision, but I wouldn't be surprised if somebody
stranger things have happened.
Just like, let's just put it to 3. It's like there are huge implications about what happens here, even by a 0.25 percentage point, because you can see how much has moved up by 0.1 from 0.1% to where it is right now and how it affects people and how the housing market is beginning to slow down in terms of the demand. But the housing market in terms of demand, the 5-year average, the demand is still 10% above the 5-year average according to Zoopla. And the lack of supply coming onto the market is still a lot less supply coming onto the market than the 5-year average.
Right, okay.
So housing market is quite stable. I've talked about this before, how this affects the housing market and interest rates go up. But the Scottish housing market is still quite robust because there's no move in the stamp duty thresholds and because we're still quite okay because stamp duty isn't a huge cost to us. Whereas in England, where the average price is in London, for example, is 525,000 to buy a property on average, then a stamp duty for buying the average price in London is going to be a huge implications. It's going to put a lot of people off. So the English housing market could actually be affected quite badly. Hence the reason why stamp duty on the threshold has actually been moved up to, I think it was 500,000, the exemption on stamp duty. So there's a big difference there as well, I would say. So that's where the Bank of England base rates are just right now. How does higher inflation let's look at it then. So does higher inflation mean that there's going to be higher interest rates? Well, that's a good question. In theory, inflation and interest rates are in an inverse relationship. So this means that when rates are low, inflation tends to rise. Like what's happening here. But remember, we've gone through a period where inflation's been historically low as well for the last 10 years. And then also interest rates have been low as well for the last 10 years as well. Very low. So that's hit that on the head. But that's the general relationship. It's supposed to be inverse. And so it was unforeseen and it was It wasn't expected to happen like that. And I've been saying that for ages. How on earth could you have historic low interest rates, historic low inflation, and actually historically low unemployment? That's just never been seen before in an economy. So, something has got to happen and something has got to come out of this. And I kind of think this is the repercussions. We're now seeing what's happening in our economy right now. And you've got to also understand that when rates are high, inflation tends to fall as well. This is almost like what Nigel Lawson used to say. It's like this one club approach to actually curbing inflation is by moving interest rates up, hoping that people will spend less as a result of what they're doing. So given that interest rates have been at a record low since the start of the pandemic, this has caused the inflation to surge. I would argue this is the last 10 years.
It goes further back than just the pandemic.
I think the repercussions is all through the last 10 years
and it's all coming to a head. Yeah.
And it's all coming to a head right now. It's like we've had this ease and we've been on a super highway. I use this analogy all the time on the motorway, and everybody's running quite smoothly. And then all of a sudden, we've now got to a stage where everybody's joined the motorway, and then we've now got a record block. And this is where the block is, and it's called inflation right now. And we have to ride this out and work our way through this. There's other ways to curb inflation rather than interest rates. It can be done by indirect taxation. Nobody wants to go there. But now we're seeing Rishi was actually right and Liz was wrong. I knew that anyway before we started this. And I can't understand why they put that idiot in power. And I will call her an idiot. In power, but it must have been a political decision because she was a puppet. A muppet, maybe. If anybody's seen that show.
I've seen it this morning.
Aye. So that's where I think everything lies right now, and the fact that we will have to tax ourselves a bit more to bring more money in to balance the books. It is now nobody's going to like what I'm about to say here, but the Office of National Statistics that measure everything knows households have saved. That's our households, us. Now, you can put your hand up and say you have as well, but nobody wants to admit this because they want to keep the money. Households have saved £180 billion in the pandemic. All UK households have saved £180 billion in the pandemic. They know that.
Yeah. And
that is where the money is that we're having to borrow to put down the 95 billion. So rather than actually get the 180 billion back that we've just given away to ourselves, because remember, we're giving it to ourselves. We're paying for it ultimately anyway. Yeah. We're now not wanting to give that back. We'd rather go to the bank again and say, I tell you what, let's borrow even more money on top of the money we've got already and slosh another 95 billion into the economy. That's no one. That's why now the Chancellor has been sacked, and now we've got Jeremy Hunt in the place, and now we're at a prediction of it's going to cost us 25 billion more than what we can bring in tax receipts in order to do that. Now they're going to have to look at what we're going to cut in services, but I would argue once again that we should actually be looking at to tax that to get that money back in. That's key here. We've got to make sure we balance the books. If we do not balance the books, we're on a hiding to nothing and we're back at where we are again. And all we're doing is kicking the can down the road and bailing ourselves out every single time. Now, that's my political bit out of the way. I don't know if anybody else agrees with that, but that's the way I feel about it. It's like, from a business point of view, we are running a business in this economy. We have to make sure that people at grassroots level are looked after, though. The most vulnerable, the people that are vulnerable in our society are the ones that we need to look after. This is why Ian Duncan Smith said we should be putting the money into the bottom and bubbling up rather than trickling down and giving the tax. I mean, because let's be honest, somebody gives me an extra £5,000. Let's put it that way. I'm just going to invest it. I'm not going to spend it. I'm going to invest it. Somebody gives somebody in grassroots level, maybe 5 people, £1,000 each. They're going to run down to the shop and spend it.
Spend it, yeah.
Absolutely. So where do you think the money should go? run down to the shop and spend it, because it trickles right throughout the economy and everybody benefits as a result. They've shown it from grassroots level when the Virgin charities and that have gone into third world countries, and they've actually created, and for every pound they put in investment, they create £3 in actually the prosperity it creates in their economy. And that's the type of things we should do right here. I'm not saying we're third world, but I'm saying
no, but the same premise.
Very well.
Yeah, and it's and explaining it like that, that makes sense. And the same premise could be implemented, just like you say, we're not third world country, but it will work the same, or it should work.
This brings it back though.
Yeah.
If the cost of living rises too quickly, the Bank of England can raise interest rates to try and slow it down. By the time they've done that, they're too late.
Yeah.
You're too late. It's like the ship leaving the harbour and gaining momentum. You're going to get the benefit in 6 months' time. So inflation, if it is rising right now, we don't know if it is or not, because they can't measure it right now until they get all the 180,000 products together and then come out with the consensus of quantitative easing and all the rest of it and apply all that, and all the statisticians get together and put it out. We can't measure that until it comes out. But by the time it comes out, we're too late. We've missed the boat, if that makes sense. It's further down the road where that'll curb. So by raising interest rates now, we'll do that. However, you have to be extremely careful. If you raise interest rates now, and we might touch on it in a wee while, if you raise interest rates far too much right now, you might end up causing stagflation. You don't want a stagflation, because that's even worse. It's healthy to have a bit of inflation in your economy because it does mean it's growing, but not too much, because it destroys savings and pensions. That's why they bailed them out with the gilts when the pension companies were selling off. So how does increasing interest rates reduce inflation? That's probably the question we've got to ask you.
Yeah. Well, I mean, increasing interest rates and how they affect how they reduce inflation. Well, let's look at before December 2021. Interest rates had been at a record low. So people were then encouraged to borrow more money, which was cheap at the time because obviously interest rates. Meanwhile, the interest rates on savings accounts were pitiful, as we are aware. So there was little incentive to save, meaning people tended to spend instead, like we were just talking about a minute ago. So, but rising interest rates have increased the cost of borrowing money again.
Richard, and this, you know what? Can I just interrupt a wee bit there and say, you see this thing about the incentive to save and meaning people will spend less? I just think that's utter bullshit. Yeah. And that's the thing that they don't understand. The world is the UK especially is run by solicitors and economists. That's it. They're academics at heart. They don't understand grassroots levels where it actually happens and what happens about what they do. And they're taught from a textbook in a university, and the fact that this is what happens. And people will actually save if you put interest rates up. Well, that's not necessarily the case. I mean, people will save regardless because they want to save for their future, regardless of the return that they're getting. They won't just take I mean, have you ever said to yourself, I'm not getting much in the bank, so I'm going to run out and blow it?
No.
I've got money. I'm going to get a lot of money. I'm going to get a lot of return in the bank with interest rates, so I'm going to start saving it.
No.
I've never ever said that. I've done what I've done and invested what I've done, regardless if interest rates are high, regardless if interest rates are low, regardless if inflation's high or low either. So I genuinely think it's a mindset thing, and it's programmed into you by the books you read and the people you associate with. And it's like this show right now. The people watching this show will take this on board. Some people will, some people won't. Some people will think we are speaking utter rubbish. And that's great, because I always say somebody's got to wash my car.
Yeah. Yeah, but anyway, but yeah, back to obviously the interest rates and how they reduce inflation. Well, in this kind of environment, and consumers and businesses and that are put off spending or borrowing, and there is now more incentive for people to start saving their money rather than spend it, as they can earn that little bit more interest. But whether people will do that or not, like we just discussed, Jim, I think it's down to the individual. I mean, if somebody wants to save for a certain reason, then they're going to do that regardless. But as demand for goods and services fall, this should in theory have a knock-on effect on prices by preventing costs from rising. So shops might even look to reduce the cost of goods to try and encourage people to start
Yeah.
buying them again.
Now, here's what I think is going to happen next, is when you think about it, the first things to go are typically luxury goods.
Luxury
So
items, yeah.
people do not spend. So in other words, let's be honest. If interest rates are high, do you then say, "I tell you what, I'm not going to go on holiday. I'm going to put it in the bank
When
and
you
save
cut
it"?
back doing things, and yeah.
But do you do that? No, you don't. You're probably just inclined just to go on holiday anyway and throw caution to the wind and say, "Who cares?" It does though, and how it's affected me, and I'll tell you how it's affected me, because I know my tolerance limits. And I know where I am right now in terms of my loan to value. And I know how high my interest rates need to go before there is something I need to worry about.
Yeah.
If I go then and borrow more money against the assets that I have and don't reinvest that, then that puts me in a more vulnerable position. And for that very reason, unless I've got something compelling to invest in, which will give me a higher return than the interest rates, I will not borrow money right now. But I'm still buying. And somebody said that to me this morning. You still buying property? As if it was a question. And I went, there's a bear shit in the woods.
Yes.
It's like if the numbers work, I'll be buying property every single day. And every other day. It's like, because it works. And they were like astounded. And it's like, why would you do that? Because the return is there. If I can make significantly higher return on my money than the bank's money, why would I not do that? And if I can have the tolerance, it's like, interest rates would need to go up to 15% before I would be going, oh my God, I need to worry. It's like, but that's the tolerance I live with. And that's the comfort I live with as well. And I'll be honest, if everybody's going up to 15%, everybody's coming with me.
Yeah, we're on the same boat at that level.
Right. So I think what's happening here is they put interest rates up, they make it more difficult. Therefore, companies have to cut back. Therefore, they have to pay people off. And paying people off then curbs the enthusiasm in the economy, which then stops people buying goods because they've not got the money to buy goods anymore because they're getting paid off, or they're getting their wages cut, or they're streamlining, or they're downsizing. And that's what causes an effect. They don't want to say that because they don't want to say people will lose their jobs. They try to do this smoke and mirrors thing about saying, oh, this is how it works and that's how it works. But reality, boots on ground, people get paid off and cutbacks are made in companies.
And then that has that knock-on effect.
All to appease, and here it comes, all to appease shareholders to give them a higher return. Now, what happened to company stewardship for a director and their responsibility to the wider community and the people at hand? It's all changed. It's like we've gone back to Wall Street where greed is good, where some companies look at it like that. It's like, no, it's if you make enough money, surely you should be putting something back into the community. And that's another show. So there's more incentive people perceive in reality, but demand for goods and services fall. They should, in theory, have a knock-on effect on prices by preventing rising costs. This is because demand falls because they lose their job. But they don't want to say that in here. Shops might even reduce the cost of their goods, trying to encourage people, as you said, Richard, to buy, and that then brings inflation down as well. But how much do they reduce it by, and where is that reduction in money going to be made? Is it going to be taken off their profit, or is it going to be taken off somebody getting streamlined, downsized? In other words, paid off. That's why the increasing bank rate is like a lever for slowing the economy, but you can't do it too soon. You can't do it too high because of the knock-on effect is seen in 3 to 6 months' time. And this is exactly the Bank of England's Monetary Policy Committee decided to do on the 16th of December when they voted to raise the cost of borrowing from the record low of 0.1%. And again in February, March, May, June, August, September. And it's going to be happening in November as well. The rate is currently 2.25%. The rise will be felt by those with mortgages which track the base interest. Now I'm a discounted mortgage, so I'm tracking that until the May next year. It's no big deal, to be honest. It's no a large mortgage, but I'm okay with that. But most people are on fixed rate mortgages. But if you're on a fixed rate mortgage right now, my advice to you is go back to your lender and see if you can push your mortgage out to a longer period of time in order to reduce the payments if you're on capital repayment, on a monthly basis till you get over this carry on, which usually takes on average, a recession usually takes 1.25 years. That has been measured for the last 120 years. It usually takes 1.25 years to get through a recession. Therefore, if you curb your amount until that happens, and then you can start going back on and bring the term back down again and pay off more debt later on once the good times return again. This rise will be felt by those on mortgages, as I said, with tracker-based interest rate. And for those on the fixed rate deals, when the deals have to come to an end, as I've said, to remortgage, make sure you do that wee tip there. You will pay a bit more in the long run, but I tell you, in the short run, you'll have less stress, and happy days will appear, because when the times are good again, you start to eat into that you've built up. The base rate also impacts on borrowing costs such as credit cards, personal loans, and car loans. With a weak economy, increasing prices, and static wages, there's a fear that the UK, as I said, could fall into stagflation. Stagflations are really, you don't want to go there. This is like a self-fulfilling spiral where everything just starts to collapse and the whole economy collapses. We touched on stagflation, I think possibly in the credit crunch. It nearly came to that, where stagflation appeared. So, Richard, what does inflation mean for savings?
Yeah, so we spoke about the savings, and the Fisher effect is an economic theory that describes how inflation relates to both real and nominal interest rates. So nominal interest rates describe how much a saver gets when they deposit money into their bank. So, for instance, if you put £3,000 in a savings account that offers, say, 1.5% interest rate, you will earn £45 over the course of that a year. However, that £45 isn't quite what it seems. So if at the same time inflation rate is 10.1%, as it was in July just past, the cash in the savings account is only losing value. So after 1 year, your 3,000 pot is adjusted for inflation, it would be worth 2,670.
Yeah, in other words, if every pint of milk was a pound, if every pint of milk was a pound, you buy 3,000 pints of milk at the start of the year. By the time you got to the end of the year, with that same money, you'd only be able to buy 2,670 pints of milk with the same £3,000 that you had at the start of the year,
because of inflation.
Yeah. So the purchasing power of your cash can be eroded when you're adding that £45 earnings. Over the long term, it really adds up. And the key thing to remember is there's a difference between real and nominal interest rates, and inflation has an impact on the relationship between the two, and understanding how inflation impacts your finances is essential when you're creating a plan for your future. How will inflation affect my pension? Let's talk about that in a minute. Let's say a couple of hellos, actually. Hello to the Jewish banker on TikTok. Hello there. And he says, actually, or she says, or that person says, need to be politically correct here. There's no way they're balancing the book for 15 years or more. That's an interesting comment. Possibly, maybe a lot longer than that. Remember, I don't think anybody realised, but the debt from the Second World War was only finally paid off in the Thatcher area in the 1980s. All that debt accrued from the Second World War was actually paid off eventually in the 1980s. It took all that time.
So that's about 50 years.
Yeah. So, we're talking about balancing the book. Books, it could be a different. Callum from Stirling. Hi, Callum. Thanks, Jewish Banker. He says, great channel. Invite more people to come in and watch us, because we'll talk about this every single week at 12:30, the Wealth Creation Show. Thank you very much, Andrea, for congratulating us on our top estate agent in Scotland, and also Silver Award for Scotland as well. And hi, Perry. Yeah, absolutely. Got any questions, guys? Please feel free to ask. Any comments as well. Very, very welcome. It keeps the show stimulated. How will inflation affect my pension? This is this is weird for a guy that says, if I'm not a millionaire by the time I retire, I don't deserve a pension. To now actually having a pension. Where did that come from?
Because you've obviously the benefits of pensions, which we've covered. So,
well, the benefits of having a pension is if you're a high rate taxpayer, you can actually put a contribution into your pension, and it actually brings you down to a low rate taxpayer. So you get the contribution back from the upshot of the lower rate, but you also avoid paying the higher rate tax because you've put that into your pension. So you get a huge bonus as a result of that. So that's why if you're a higher rate taxpayer, you'd have a pension that you could make additional voluntary contributions to outside of your normal work pension. If your work pension doesn't allow you to do that relationship, your work pension might just be dog shit, to be honest. Excuse me, I'm getting very vocal this, but the reality is work pensions are they're not that great, I don't think. I think people should actually have a proper pension outside of that from a top performer, and actually, and we've done it on previous shows, Richard, about pension versus property, possibly. On a previous wealth creation show, if you look back on the playlist on YouTube, you'll see that property versus pension, where we talked about what the two differences are. But pensions are really important. We will all have a pension by the time, well, we won't. You will, Richard, because you're 20 years before me. So you're 20 years younger than me. You'll have probably dare I say, a decent pension. Says to gritted teeth more than anything, because I mean, what is decent by the time you get there? But I would say you've got to do a side hustle outside your normal pension. You've got to add more money into your normal pension, because everybody else is getting the same contributions put into their pension. So all the government has done by company pensions is actually to basically pass on their responsibility and to abdicate the responsibility, not delegate, to abdicate the responsibility. Because in years to come, the country and the government will say, look, we can't afford pensions anymore, so we're not going to pay you anymore. Or it'll be a token gesture of maybe a couple of £1,000 a year to go towards your company pension. But by putting in your normal day-to-day pension, you'll be exactly where you are right now, because everybody's standard of living and inflation will move up to that, because all that money will be in the economy and sloshing about when all the pensions start to come out. Makes sense?
Yeah.
So do a side hustle and make sure you earn more out of that, so you can at least have a better standard of living than the normal day-to-day person, because they'll just have the same pension as you. That's ultimate. More or less what you're saying is the company pensions will end up being state pensions. And if you can survive on your state pension right now, good luck to you. But if you can't survive on your state pension right now, you know people that can't survive on the state pension right now, that's why you have to do it, because that's effectively what there will be in terms of purchasing power later on. So let me talk about and get back to this. The final question, I think it is here. How will inflation affect my pension? Unfortunately, higher rates of inflation reduce purchasing power with our cash and the value of our pensions as well. If you say your pension grows by if your pension grows by 5% every year, but inflation is by 10.1%, as it is and as it was in July, and 9.9 as it is now, your pension has actually decreased in value by 6%, because it's the differential, isn't it? Because the price of everything to buy is a lot higher than what you're actually making. This is why I talk about property investment. If you can make a return of 15% and you can borrow at 5% from a bank, then you're making a differential of 10% every single time. And it's the same with inflation and interest rates. If you're getting a return of 5%, but inflation is 10%, you're losing 5% every year on your money. So that's why you have to make sure you have the right investments. You might see this written as an increase, and most people actually in the government refer to it as real terms. So, an increase or decrease in real terms. In other words, real terms means what you've got in your pocket and what it's able to buy in comparison to what it was able to buy the year before. This is why property prices, for example, in the last 20 years, property prices have gone up 170% in the UK. 170% in the last 20 years. But property doesn't really make you any money, does it? Aye, right. It's gone up 170% in the last 20 years, property. Inflation has gone up 70% in the last 20 years. Therefore, in real terms, here we go, property has actually increased 100% in the last 20 years. I'll say that again. Property has increased 100% in the last 20 years. It has doubled. So if you invested in property, you have now doubled your investment on average. And here's the kicker. You've been paid to wait while it's gone up as well, if you've rented them. How great is that? It's also worth it, and that's a great pension. That's a great additional to your pension. It is also worth considering compounding inflation, just as the effect with compounding interest on savings and investments. Inflation will slowly erode the rate of growth in your savings and your investments. Instead of occurring in a vacuum, where prices are reset to zero each year, inflation compounds over time, and so its impact can be significant on long-term savings like pensions. Well, look at the pension. If your pension in the last 20 years has only gone up 50%, guess what? In real terms, you've lost 20% because inflation's been 70% in the last 20 years. That makes sense, Richard?
It's the difference, yeah, it's the difference.
Yeah. So this is why some asset managers, pension providers, put my teeth back in, measure the inflation-adjusted returns on particular investments. One other key element of how inflation affects pensions is the triple lock. Introduced in 2010, this policy means that the state pension rises each year by the highest of the three factors we're going to talk about now, which is 2.5%, inflation as calculated by the CPI, the Consumer Price Index. This is why they didn't want the retail price index, by the way, because they were having to put the state pensions up by the retail price index, and they changed it, and they went, we better measure it by the Consumer Price Index. That's why they've done it. I remember now, the penny just dropped, actually, why they changed it from RPI to CPI, because they didn't want to fork out more money because it was including interest rate rises as well. And they assumed that pensions, obviously, you'd probably have paid off your property, so why would you be including interest rate rises? But still, they changed it for that reason, because it was lower the other way around. See how they do all that? Or the triple lock is the 2.5% inflation calculated by CPI, or the average wage growth. So it means it's the highest of one of these three things there. As a result of the pandemic, artificially inflating wages to 8.8% due to millions coming off a furlough and onto payroll, the government decided to temporarily suspend the triple lock. It's like, we don't like that calculation. It goes against us now. Let's change it.
Yeah.
See how that's done? They're a bunch of bambots. But in April 2022, the wage growth element was removed, meaning the state pension only increased by 3.1%. The rate of inflation in September 2021. See, they just change things to suit themselves.
Yeah.
Confusingly, final salary payments tend to increase in line with the RPI measure of inflation, as well, which I explained previously. That for me says it all. Yeah. This is why I keep saying, and put it in a nutshell, have I just clearly demonstrated, hopefully I've clearly demonstrated to everybody there, how the government manipulates their figures to suit their purpose, to the detriment of the people that are actually feeding the tax and the national insurance into them. It is the biggest Ponzi scheme going, the national insurance system, because what happens is all the money goes up, but the majority of it doesn't actually flow back down to the people. It actually gets absorbed by bureaucracy, and actually all the what we call the state jobs, which are all the MPs, houses of parliament, everything that goes on round about there. Now, I'm not saying I'm anti towards that, but I'm saying it should be run more fiscal, with more fiscal responsibility. That's what I would say. So I would call the government out and deliberately manipulating the figures to suit their purpose. Most people would anyway. Anyway, finalisation. What's your thoughts on all this, Richard?
Yeah, well, obviously there's been a lot of interesting facts and statistics today. Obviously, inflation and interest rates do have that inverse relationship, but we've proved today not always, and they do have an effect on everybody's individual circumstances. So you need to kind of keep your finger on the pulse and be educated to the fact how it's going to affect you.
I'm quickly going to cover a wee bit here. The Jewish banker says, I now realise why banks started in Scotland. I'm not really sure what he means by that. It was tight. But he says, "Who's Richard? Where's Richard?" That's because Richard's not got 1,000 people on TikTok yet.
That's because I've not got enough
Everybody get onto
followers.
TikTok and follow Richard and get him up to 1,000 so he can come on this show on TikTok. Anyway, guys, I'll leave it at that. Hopefully, I've got a great insight. Spread the word, get people involved, get them educated, make sure they know what the inflation is, make sure they know what interest rates are and what the correlation is between both. And we'll see you next week on the Wealth Creation Show. Bye-bye for now.
See you later.